All right. Good day, everybody. Welcome to our first BioTools Innovator live panel for 2022. I'm Ayelet Murom. I'm the program director. For those of you joining us through the live stream on LinkedIn Live or YouTube and are not familiar with the accelerator, BioTools Innovator is an accelerator program and competition. We are powered by MedTech Innovator, and we are the first ever accelerator program designed to support early stage companies developing life science tools and diagnostics technologies to improve human health. As part of our weekly summer webinar series, we are bringing together industry leaders to provide insight and guidance on selected topics. The first of which will be today's panel discussing one of the most important factors to any company's success, fundraising. And today's discussion will focus on fundraising within the BioTools industry and the current environment. As mentioned, we will be live streaming this panel discussion today, both on YouTube and LinkedIn for the first time, so you can join us through your media of choice. For the first 60 minutes, we'll be live streaming the discussion, and then have 30 minutes of a private Q&A for our cohort companies. Feel free to drop your questions in the comment sections on LinkedIn or YouTube or in the Zoom chat if you're part of our cohort. So without further ado, to introduce the panel and kick off the discussion, I'm going to hand it over to our moderator for today. She's the Managing Director for BioTools Innovator and the COO of MedTech Innovator, Catherine Zavala.
Great, thank you, Ayelet. It's really nice to be here. Today, our first topic is going to be the VC perspective on fundraising in the BioTools space. And so I'm joined by three experts in that field. So I'm going to start with ladies first. Jenny, if you want to give a brief introduction about you and your fund. And maybe a bonus question, how many BioTools deals have you evaluated in the last year and how many have you invested in?
All right. Thank you so much for bringing us together today. Happy to be here. My name is Jenny Rook. I'm the founder and managing director of Genoa Ventures, which is a San Francisco-based venture capital firm that focuses on investing in early stage companies, mostly seed and A, innovating at the convergence of biology and technology. And a major category is, as you said, BioTools. I took a quick look at our database. It is the number one category in our deal flow. About 20% of our deal flow. We will look at hundreds of BioTools deals in a given year or so, and invest in the last year, only one actually. So that's the kind of ratios we're looking at.
All right, thanks, Jenny. Great to have you here. And then we have our partners at both RCT and Broad Oak Capital. So they are the driving force behind setting up BioTools Innovator. So let's start with Chad. A brief introduction, same kind of bonus question. How many BioTools deals are you guys seeing and investing in?
Great, thank you, Catherine. So glad to be here. Chad Souvenir. I'm with RCT, Research Corporation Technologies. We're life science investors. We about $500 million of investable capital as assets. We invest across the life sciences space, investing in devices, a little bit of therapeutics, but not clinical trial-based therapeutics, and tools. We have been investing for a long time. I've been involved in tools investing probably for the last 20 or so years. We're at RCT for 20 years. We look at also in the hundreds of companies per year. Probably I kind of took a look back, and I think historically probably about 300-ish or so deals a year. We take a closer look at somewhere between 30 and 50, and ideally we'd invest in probably 3 to 5 new companies per year.
Great. And Brian, over to you.
Hello, Brian Poltolov with Broad Oak Capital. Broad Oak is a merchant bank focused very much in the commercial stage tools and services space. So somewhat similar to Chad, no, not really therapeutics and not really true traditional medical devices, but and Jenny's fund actually as well. We are in our 15th year with Broad Oak, our fifth fund. It's a little over $100 million. Our fund is. So we're making equity or debt investments in commercial stage companies. Actually, that's been the traditional Broad Oak model for the last decade or more. We're actually starting up a new venture fund within Broad Oak as well to help to support and engage with earlier stage companies that are just before or right at commercialization. So that's a little bit of an expansion around where Broad Oak invests. I actually feel like I talk to a new company every single day. So hundreds is definitely right that we speak to. We've been pretty active actually in terms of making investments. We closed on our fifth fund. We did a final close in the beginning of this year, in Q1 of this year, and we are already 30+% of the way through invested in our fund. So it's been a pretty aggressive clip. It's great to see new technologies. For sure, though, we talk to a lot more people than ultimately we're able to invest in. But there's a lot of great companies out there. There's a lot of great entrepreneurs out there, and very excited to meet more of them. I guess I got a couple more days in this week, so I got many more people to meet.
That's great. And you brought up some, good points, about how you work with companies and the difference. I got muted there, and the way that you work with them. So one of the questions I have is, once a company becomes part of your portfolio, how do you work with that company? And also, maybe for the ones that, don't, I know there's a lot of scientists become entrepreneurs in this space. Where do you see kind of their biggest needs, even before they become a part of your portfolio? So Brian, we'll start with you on that question.
So we're very active investors. We're very actively engaged. Certainly, if we're going to invest in a company, we're going to do it because we're passionate about it. We see a lot of potential there. And frankly, we're going to make sure that we are giving the company a lot more than just dollars. So we may or may not sit on a board role. Frankly, more times than often than we don't sit on boards. I don't think that's necessarily a requirement. It really depends on the company and the investment and the structure and so forth. But we're going to play a very tight advisory role with the company, and we're going to help them. And I would say the substantial majority of the companies that we invest in, they welcome it, open arms. It comes in a number of different flavors. Sometimes it's a little bit around strategic decisions, around where they should be making investments, around product development or scaling an organization or thinking about building a commercial team, those types of considerations. Sometimes it's connections either to biopharma or other KOLs or to tools players, strategics in the space, some of the big players that maybe one day could be a acquirer, but also could be a commercial partner or a collaborator or a number of other forms. So we've been engaged in the network for a long time, very much like Jenny and very much like Chad. And so we really want to make sure we're taking advantage of those connections, taking advantage of the fact that we see a lot of deals. We see a lot of companies come in. We see a lot of people asking for money. We see a lot of people asking for future money and so forth. And we'd like to continue to invest in companies and help companies that we do invest in raise additional money to help to really fulfill their ambitions. So those are all areas where we think we can provide value to companies.
Great. And I'm sure it's very similar with RCT and Genoa. Jenny, do you guys like to take board seats? And do you notice any difference between, scientist entrepreneurs versus ones maybe that had commercial experience?
Yeah, so we do often take a board seat. I should mention, so there's 10 people on the Genoa investing team. All of us are scientists by training, and all of us have been operators. So we've been on that side of the table, and for better or for worse, have been involved in building startups. And so we do this work because we love building great science-based companies, and we love helping founders build great science-based companies. It also means we've all been through that journey of trying to go be a scientist and then be something else. And we know the sort of awkwardness is there, and the ways that one has to expand and level up and work with others. I think those are some of the real challenges, is going from being a often individual contributor, or very focused, isolated person at a bench, for example, and then moving out to working in a team, and how to do that, how to do simple things like run meetings and know about what one's individual strengths are versus a team member's strengths, and how to divide up work while still supporting each other and keeping each other accountable. So I think there is a lot of growth that happens there for scientist founders.
Right. Chad, RCT, do you guys like taking board seats?
Yeah, we generally will take a board seat in some of our larger investments. Sometimes if we're partnering with other funds, we may take a little bit more of a back seat, but oftentimes if we're going to come in and lead around, we're generally going to take a board seat and want to have a pretty active role in the evolution of the company. And then I would say, I think from kind of what the companies need, they're all a little bit different. I mean, every company seems to have a little bit of a unique flavor to it. And we try to look at each company and think about what resources do the company needs. Sometimes that's helping build a management team. Sometimes it's helping bring in other investors. Sometimes it's helping think through product strategy. Sometimes it's thinking about product launch. And so, we try to use our networks and use people that we know and people we've worked with in the past to help bring them to the table and help the company grow and expand upon its vision.
Awesome. So I guess before we dive into more about how you guys look and evaluate opportunities, I think the big elephant in the room is this idea of a recession or an economic downturn. So maybe Chad, starting with you, kind of what are you saying? What are you guys telling your portfolio companies? How is this affecting how you're investing now or in the short term?
Sure. So, I think for us, it's not really having an impact on our investing strategy, right? So I don't think we're dialing back our investments. We're going to continue to deploy capital, probably at a very similar rate as we have in the past. We are seeing, I think across our portfolio, it's a little bit spotty. I think that there's, certainly some of the COVID revenue that was very common across tools companies has come down. And then I think there's some weaknesses in different spots in the marketplace as well. And so, a lot of our companies are revenue generating companies, and that's a big part of their cash flow management, is that they're going to use that revenue to continue to fund operations. And so certainly we're trying to be cautious and understand the runway in our companies. Most of our companies aren't burning that much capital, so we feel like they're in largely good spot. But every company that we're involved in, we've taken a look and tried to understand the runway in that company and just take another look at that again. So I think there's a little bit of caution, but I don't think, for us at least, that it's been a major disruption. I think certainly the public markets have taken a big hit, and there's been a lot less activity there. And private markets maybe have come back down to earth a little bit. And so we do anticipate that there will be some more difficult times going forward, but we haven't seen all that much yet.
It's helpful, Chad. Jenny, I know you mentioned that Genoa finished raising their current fund last year, so you still got some money that you guys are working on deploying. I guess what we call dry powder. But how is that being deployed? Are you some people are saying that investors are pulling back because of what's coming on the horizon. And do you feel that's the same for you guys?
No, not in general. I would echo Chad's comments. I think as anyone who is building early stage BioTools company knows it's a really long journey with plenty of ups and downs, and we can't predict what the challenges and headwinds are going to be, from the seed stage forward. But we know they're coming, whether we're the management team or the investors who are supporting them. And so I think you can generally predict that over a 7 to 10 year fund life or a 7 to 10 year capital journey for a startup, there's going to be tough times, and they might be macro environment related, and they might be supply chain related, and they could be, there's all kinds of issues. It could be competition, et cetera. So I think the very things that make it really challenging to build startups and invest in them are also the things that make it quite resilient, really well suited to this particular moment and the challenges. Is everyone listening who's thinking about building a company the years ahead is always thinking about contingency plans and downsides, and that's what we try to do as well as investors, and as partners to our founders. And so it doesn't really change the day-to-day deployment, because we're really looking well past the current turbulence to the horizon.
Sure, that makes a lot of sense. It sounds like, between you and Chad, it's, not a particularly unique time, as, you're always preparing for something like this potentially happening and trying to lengthen the runway for these startups. Brian, Broad Oak has different ways of deploying capital, not all investment. You mentioned debt. So is there any difference that you're seeing there, predicting?
I would say we're certainly seeing an impact. For sure, the customers, a lot of the pharma customers, they are certainly, we've seen some entrenchment a little bit, based on stock prices and some conservatism and some concerns and just risk. I think that we are, I think that's a little bit impacting some of our commercial stage companies. I think our earlier companies, it's probably a little bit more muted in terms of the impact. I would say from a valuation side, we're certainly as well seeing a little bit of a pullback as well. Although I don't think it's really stopping deals from happening. We've actually had two portfolio companies who have just signed term sheets in the last 2 weeks. So we're certainly seeing good traction. But I will say valuations are a little bit different than probably they looked 6 to 9 months ago. I think that the private markets very much kind of follow the public markets in this regard, although I think to maybe Chad's point, or maybe it was Jenny's point, to a little bit of a lesser extent. I think actually, depending on what you believe about the future economic climate, it could potentially have more of an impact. Where I think this will really have a bigger impact is when you see companies that raised money 9, 12, 18 months ago, if they have to go back to the markets for another raise, and they're going to be raising money maybe underwater from where they previous raised, I think that could actually have a greater impact. Now you have to think about how sustained is this going to be. I personally am very much a believer in the fundamentals around the space, and especially around some of the emerging areas where we're investing in technology domains and so forth. So I'm relatively optimistic in the medium to longer term. And I think this will be, it's obviously painful. It's not going to be as short as anybody would like, but I think we're going to get past this. But if you take a more pessimistic view, I think the longer it sustains and companies have to go through that fundraising round sequentially, I think that would be, frankly, a lot more painful.
Do you have any advice for those companies that are in those positions now where they're having to go back to the market?
I think there's a couple of things. First of all, it's always kind of shades of gray and where are you? So I think it's all the much more important to do your scenario planning and mitigation measures and just thinking about staging and sequencing. This is still a very dynamic market. A lot of the areas where we invest, the technology is evolving pretty fast. So I do not think that this is an area where companies should be retrenching and just kind of hunkering in and not really investing in their core assets and their core technologies. Because I think the bigger risk, frankly, in many cases, is that you're going to get kind of left behind from the market. Either customers are going to, you're going to be left behind from customers or other competitive technologies and so forth. So broadly speaking, I would not say that, but thinking about flexibility, thinking about optionality and so forth is certainly going to be important. And then I think as well, thinking about when you are in a position, or when companies are in a position to raise, thinking about how long they want to raise for, and how much to go with a bigger round now versus thinking about a bridge or something like that. We definitely see some companies that are focused on some bridge options, which I think actually could be potentially a good option if A, you think the macros are going to look substantially different, and or B, the company just needs a little bit more money to get past some substantial milestones that's going to add material value just to the inherent to the inherent fundamentals or commercially and so forth. So I think those are some considerations that I'm seeing companies do a little bit more of, and I think make a lot of sense in this current economy.
Yeah, Chad or Jenny, do you guys have any comment on, the idea of going after a bridge around, and a lot of our companies currently are fundraising, and that's one of the things they're thinking about.
I guess one piece of advice I would throw in is if you already have some investors, be sure to have the conversation with them sooner rather than later about capital planning, what they need to see, what their appetite is, what you can count on from them. It's really helpful, I think, fundraising is hard and scary regardless, but it can help to know you've got a backstop. It'd be great to know, for example, it can even be manifested in an actual term sheet from your insiders, right? That says worst case scenario, this is what we're going to do, that maybe you don't have to use. Just knowing that you've got that can give you a little bit of that extra swagger when you're fundraising in the marketplace.
Okay, that's helpful. So fundraising obviously is a big topic. Some of our companies, this is actually their first time going out there. Many of them are in the earlier stage seed round. So Chad, maybe, with you, what does a typical due diligence process look like, even now or before in normal times, and how long does that usually take?
Sure. So our process is really trying to walk through the fundamentals of the business plan, right? So it's trying to understand the product, the market fit for the product, how far along the product is in development, what's necessary to launch the product, what does the management team look like? So it's what is the monopoly position going to look like for the company? And so it's really trying to understand that and the vision that the management team has towards addressing each of those points. So it doesn't necessarily need to be that all of those components are complete or filled. We're looking to build that business plan together with a team. And I think the more I do this, the more I realize part of the process is not so much what's down on paper, but the relationship that you form with the management team and the CEO and the founders of the company. And a relationship on, can we work through issues that come up? As Jenny said, there's going to be bumps in the road along the way, and the companies that we've had that have been successful, it's really been a partnership where we work with the management team to solve those things. And so that's actually become more and more a part of my diligence, is just that relationship forming with the management team. I'd say typically, I don't know if there is a typical diligence, but if we come in and the company's really, we may have been following them for a while, and we're ready to make an investment, it's probably a 2-month process to kind of work through all of that, the diligence plus term sheet plus getting to close. That's not where we typically come in, right? So we may follow a company 6 or 12 months as they're moving through the process, try to get to know them, try to form that relationship. And so I wouldn't think of it as as totally just a start and stop time frame. It's a relationship building process, and so that can be a bit longer.
So I guess putting you on the spot with that, what's kind of been anecdotally, maybe like the longest relationship you've had that led to an investment, and then maybe the shortest on the other end?
You know, for sure, I know there's been companies that we've been following for more than a year that have come back, and we've then made an investment later, right? And those are typically, you know, one I'm thinking of is probably close to 2 years by the time we pulled the trigger, and they were early in product development. We've invested right about as they were going to launch their product. And they had some management changes, so there's kind of a whole series of things that kind of walk through. Shortest, you know, it probably is in that 2-month time frame where we just, you know, happened to cross a company that where we've actually been looking at or understanding a marketplace, and we're saying, okay, there's really a need for this opportunity. Maybe we went out and found the company that solves that issue in the marketplace, or maybe, you know, they just we happened to stumble across them. And, you know, where everything's kind of lined up, a business plan, we kind of have a view of a business plan in our head, and then here comes a company that fits that.
Jenny, how about for you? You know, kind of similar questions. What's kind of been the longest and the shortest? Do you have like kind of a syndicate come to you and say, hey, you know, we've got a really great opportunity, now we're just looking for a lead, and does that join the process?
Similar answers to Chad, and that, you know, by virtue of being often the first round investor, you know, leading the Seed A, we may have been talking to the founders, perhaps they're an academic founder, many years before they actually, you know, start the company and are looking for funding. And we're happy to have those conversations. We hope they help founders think about the kind of company they want to build, and then when they're actually ready to raise, we're there to have that conversation. So, you know, is that diligence? Sure, right? That goes in the dossier of, you know, building the fact base of the company, but it doesn't really kind of start the clock on that intensive process of saying, okay, you're a company, you know, you want to raise, you know, this amount of money, and these are the use of proceeds, and that's a specific investment opportunity. That usually takes us at least 3 months to work through, sometimes longer, you know, from a standing start. We generally don't. That's generally not terribly helpful. The specific scenario that you described is we have a lot of capital around the table. We're looking for a lead. Yeah, that's every one of our potential deals, right? So there's a lot of capital out there that is quite rightly excited about this space and wants exposure to it, and doesn't and shouldn't lead, right? And hangs back and, you know, would like to invest with an expert investor like Broad Oak or like RCT or like Genoa. So that doesn't really affect our process, because we're hoping to partner with the company to create a great syndicate. We generally, when we're leading, we wouldn't take the whole round. We would look to go find a complementary investor who brings something that we don't have to the party, and who wants to be there for the long term with the company. So that's a more of a handcrafting the syndicate rather than kind of catalyzing the capital that happens to be hanging around hoping something good happens.
No, that's right. You know, Brian, going to you last on this question, but is very similar kind of, you know, timelines for Broad Oak and how you guys invest?
Yeah, I think so. I would say, personally, for me, some of the investments we've made, some of these, I've been with Broad Oak for 2.5 years. Before that, I spent 12 years with Thermo Fisher. Probably should have mentioned that in the intro, but so some of these companies that we've invested in, actually, I knew them. My relationship predates Broad Oak, but actually from my days in the industry. So it's great to have strong relationships there. And for sure, it's certainly not ideal if the first time you're talking to an investor is when you have your hands out asking for money. But it does happen. And to Chad's point and Jenny's point, you know, we've invested at all stages. I would say in terms of our timeline, that is one advantage we do have, because we do debt investments as well as equity investments. When we do debt investments, it actually helps us to even move that much faster. Because obviously risk profile from an investor standpoint looks a little different, et cetera. So some of our deals we've closed in 30 days or less, but I would say 45 days is probably about on average, and some of them certainly go 60 or so.
Great. Well, I know this next question is going to be a little bit tricky to answer because, I think it's different for every question, for every company. But, some people kind of want to know, like, what are the most important milestones you look for at each fundraising stage? Like, what should a seed company have versus, a Series A or B company? Jenny, I'll start with you on that.
I love this question, actually, because we have a little bit of yes, every company is different in their specifics, but we do have a little bit of a playbook that we think works for BioTools companies in particular. And I would say the guiding principle is all about the stage-based risk that the companies are retiring. And so what are we hoping that the company can generate proof for at each stage that helps them access the next round of capital and hire the next group of people, et cetera. So for seed, we tend to focus on technology development, so technology proof of concept. Does the fundamental innovation that is driving the tool, whether it's the optics or the analytics, or usually some combination of the microfluidics, all the technologies that are coming together, is it going to work? Right? This is one of the differences in investing in these kinds of deep tech companies versus software where generally whether it's going to work or not. Here it might not work, and truly innovative companies are typically taking a leap there. And so in seed, we want to have some pretty good evidence that the core innovation is going to work and that it's going to be protectable. So that comes to IP as well. In the A, we're moving from technology development to product development. Can the company take that core technology and define and show proof of concept for the product that's going to go into the marketplace? And that's both often making a prototype, but it's also getting that initial kind of pre-market feedback from customers that the product that the company has defined works for them and the needs that they have. And then by the time we're getting to the B, we're really looking for product market fit. So that's that. And generally you're looking for some kind of product launch that could be as small or as constrained as a really well constructed beta program, or it could be, actual products on the marketplace. But generally showing that that the company has indeed generated a product that customers are buying, which we think really sets them up for kind of the subsequent stages, the C and beyond, which is kind of all about growth, commercial growth and product roadmap. So that's the rough playbook we bring to thinking about BioTools, obviously customizable for each scenario, but there should be, rationale as to why.
Yeah, and kind of a follow-up question before I go to Chad and Brian, but in particular with some of our companies, how important it is to have proof, this validation with a very niche market versus going after something that's much bigger, can have a much bigger return.
Yeah, this is worth an entire talk in itself, getting that right balance between the essential focus that a company has to have, particularly a kind of technology platform company, to prove that it can get a product to market that market wants. And I think of that as the sort of pointy end of the go-to-market spear, balancing that with a technology-driven product development engine behind that hopefully generates a lot of upside in the future, optionality and upside. In the early stages, I think of those as at least an 80-20 balance, probably more like 90-10, in that the company must show that the technology works and can make a product out of it. Otherwise, none of that optionality matters. And if you can't get the product out there, you don't have the opportunity to take advantage of all of those other future technology options.
Catherine, you're on mute.
All right. No, that was great, Jenny. I was pivoting over to you, Chad. I know you've been at many of our events. You've seen companies, reaching different milestones, being able to be very successful in a very niche market. I guess kind of following up, what kind of milestones are you looking for, and is it a similar balance that Jenny mentioned about having technology validation and a product that you're able to get to the market?
Yeah, so that Jenny's answer was outstanding, and I don't think I can really add much beyond that, it was, I think, very much largely the way we look at it and think about things as well. So maybe just I'll add maybe a little bit of detail. So we're really not doing seed investing, the tech development of it. And so generally we're coming in once there's a product development, maybe it's data unit, something like that level. And we're spending a lot of time. I think companies can add a lot of value in that process and getting market feedback, spending time with customers. I think some of the best business plans that I've seen or best pitches that I've seen are people who've gone out and talked to 50 customers, and they're bringing that feedback back into that product development process, and then can lend those customers to us to do diligence, and maybe we can get a little bit of a different perspective on why the market's important or why this product fits into the marketplace. I think kind of the next piece of value then is to get those customers get those products into the hands of customers, and that's I think generally where I feel very comfortable coming in is once the customers actually had their hands on a product and can give feedback, because it's amazing the number of things that a company learns first time their product goes to a customer and nothing works the way they want it to, and everything's we thought it was going to do this, we thought this was important, and they don't even know how to inject a sample into the instrument, right? It's just there's so much feedback and so much learning in that whole process. Is what's and that whole component is what really makes launching a product difficult, right? And so that's some risk that we're just trying to avoid, and really trying to jump in as that product is starting to get into a final form. So I think that whole process adds a ton of value and adds a ton of investability into a company, and it's just such a great learning process. And then I think Series B, we're really looking for companies then that are starting to get commercial traction. It's units sold, who they're selling to, how repeatable those sales are. Those types of things are what we start to look at once the company's commercial and is raising its next round of financing.
So switching gears a little bit, Brian, looking at your kind of investment strategy, companies you look at, we've talked a lot about technology validation, having a product, having a customer. How important is the team? You hear that saying, we're betting on a jockey, not the horse. Is that really true? Does that resonate for you?
100% resonates. 100% resonates for sure. We are looking to, put money into investable management teams, and investable CEO, I think, is really critical. Most of the companies that we are investing in, we realize that this is not going to be the last time that they invest. And so we want to make sure that we can support them, and ultimately they can be successful in raising additional money, in leading a team, and really building a business. And so it does need to be technology and product. I think to the extent that companies are further along down the path, then you've mitigated more and more of the technology risk. But for sure, the team part is really important. I will say a lot of the companies we invest in, they don't necessarily have complete management teams. Many times they don't. And so we want to make sure we have a strong point of view around what needs to be done, and some agreement around that. And we have that explicit discussion with the CEO and with the leadership team. And in some cases, we've invested in companies with a good CEO who's right for the right time, but ultimately isn't the right CEO to carry the company through for multiple years. And that might be okay, but we've got to make sure we have confidence that the leadership at the right time is in the right place. I think it is critical. I don't think there's anything we can do to do past. And frankly, our ability to influence change or really help a company, if a CEO is really not the right person, it can be pretty limited at the time. Technically, we might be on the board, we might be in a control position, but these are not the way that you want to help to influence the company direction and help to steer. You really want to be able to help to support and aid, and usually that works out fine, but there's always other scenarios.
Yeah, and you brought up a good point. Maybe it's a great CEO for now, for this stage of the company, but maybe at a different point they're going to need a different CEO. But starting with an early company, a lot of times it is what we talked about in the beginning. A scientist who had a really great idea now is an entrepreneur. I mean, what can that scientist do to kind of build out their team or build more credibility on the commercial side? I mean, maybe that's a follow-up question for you, Brian, and then to some of the others.
Sure, absolutely. So I think there's a couple of things. First of all, kind of surrounding yourself with people who complement. That's a little bit of a trite statement. We probably many heard that before, but think about your board, think about your advisory team, think about your management team, and you probably can't hire all of the rest of the people that you want. That would be ideal, but prioritize those roles that are going to complement your skills and what you're going to need to be successful there. I think is really, really important. Look for investors much the same who are going to really help you and help you round out. I think that's important. I think the other piece is a little bit of a reality check and just a candor and transparency. I'm talking right now with a company who has a CEO, and I like the company. It's a potential investment that we might make, and the CEO has said, "Hey, look, I want to get the company another 3 or 4 or 6 months, and I want to actually move into a CSO role and hire a CEO who's going to be a more appropriate leader for this company for the next stage." And the fact that we can have that conversation, we can see that they're committed to that, et cetera, increases my confidence in investing in the company and in the leadership, as opposed to trying to dress up and play the best you can and so forth. So I think that transparency is really important in terms of trust building and ultimately in terms of confidence building in the company.
That's a great answer. And I'm sure, Chad, Jenny, you guys have very similar thoughts. But if there's anything you want to agree or disagree, Jenny, I'll start with you.
Sure, I'll just amplify a couple of words I heard each of you say, because I think they're really important and very actionable. And Catherine, you use the term credibility, I think is so important. One of the real struggles for an early stage company is how do we get taken seriously? How do we get the attention of people we want to hire, investors? And Brian mentioned among his several great points there, the advisors. And I think that can be such a high leverage, high impact way for early stage companies to get both the guidance they actually need and then work and networking, but also the credibility that they need in order to keep expanding teams. So it really grows on itself. Knowing that someone that is referenceable, that a person knows either by reputation or directly because they've been in the industry for a long time, as Brian was talking about, that can really make the difference in whether a company gets that meeting, whether that's with an investor or someone they want to hire, or a partner or customer, right, in the early stages. So finding the best advisors early on, getting them involved, and this is not, by the way, just slapping their name and picture on a deck, but I'm not going to name any names, but I think we can all list, a few people. Like if I see one more deck with that guy's face on it, I just throw them out because I know that he's not involved. It's just a celebrity endorsement. And so what I really mean is quality people who are bringing information and wisdom and guidance to a company that you need, and that are going to be willing to speak to other people, including investors, about why this company has the real potential to go the distance.
Have you ever been an advisor for a company, Jenny? Is that something that you do, even though you have your investment, besides being on the board, maybe an informal advisor?
Interesting question. It's not something I can do very much of, because it is sort of the currency that I can offer to our portfolio companies, and my time belongs to my investors, my LPs, and so I need to be using it that way. With rare exceptions, if there's a company that's really not ready for investment, but I think could be, and my involvement is very specifically going to perhaps help get them there and position us to potentially invest, then that's something I do. But generally, generally I'm not the best advisor, right? You actually want people who are operators and who are building companies and have done that recently. So that's another reason I might decline and suggest an even more impactful person for the job.
That's great. No, I love that. I love that answer. So Chad, maybe switching a little bit of gears and trying to close up this section on milestones and team. What are some other kind of considerations when you're making an investment if we haven't talked about it? But more importantly, what are some big red flags?
Yeah, so, I think on the red flags, and Brian maybe got into this a little bit, was, it really comes down to me, the biggest one is trust, right? And so, is the company really being fully transparent with you? Which there's a lot of ways that can be, is the product, they're telling you the product's going to be launched in 3 months, and you start to dig in and you learn, and you're like, oh, this thing's not anywhere close to being ready to launch. It may be projections that are just way out of whack. But, when you start, I'll ask questions, the same question over and over, different ways, and you start to hear different answers. And I think to me that's probably the biggest red flag, and it really again comes down to like partnership. I want to have a partnership with the founders and the management team to help build a company, and there's a relationship there that I think is really important. So that I think is kind of the fundamental component of it, and when that doesn't seem like that relationship's going to be there and be a positive and productive one, then it's something that I don't think we're going to want to do.
Jenny, I know you mentioned if you see a certain advisor on the deck, you throw it out. Are there any other red flags for you?
One is the flip side of the focus topic that we were talking about earlier. There's a slide that I made when I was an operator and that I watch for index. It's not so much a red flag as an indicator of the company's not quite ready yet. And I call it the hub and spoke slide, where the company's technology is in the middle and then all of the markets they could go after are around it in this, radiation. Yes, that's very exciting, and that's a thing to know about. But when I see that a founder or a company hasn't made that crucial transition from being technology centric to market centric and customer centric, and where they're making those hard choices of, we are going to solve this problem in this market for these customers and users, and that's attached to this much money. That's a really essential decision that a company has to make. Now, we will occasionally invest in a company that hasn't quite got there and has defined and knows that and has defined a process by which during the seed round they will do the customer discovery and pick, and we know it's kind of one of several. But if they aren't self-aware that that's an issue, that's not a business plan, then that's a non-starter.
Well, that's great to hear, because I know there's a lot of companies that, have some really awesome technologies, and there's a lot of different potential. And sometimes you need a little bit of that early funding to be able to explore, which of these markets should we really go after. But that's helpful to understand. You guys do have that if they have that self-awareness and just such a killer technology. Brian, closing out here, any other red flags or turnoffs you want to add?
No, I guess I would say just most times when we invest, we're the first institutional dollars. Sometimes when we invest, there's other groups that have invested before. And we do look, obviously, at prior fundraisers for what companies have done. Typically, they might have raised some money, and it could be friends and family, or it could be some angels, or it could be a venture group or somebody else. But we are thinking a lot, not just about the financial terms that a company takes, but also who they chose to invest in, because obviously that's a big commitment for the company, and it's and so forth. And it's probably somebody that we're also going to work with in the future. As well. So I think that's also a consideration that we look at and we think about when we're making a future investment in a company. And I would encourage anybody who's thinking about raising money to think about not just the round they're in right now, but the implications for future rounds in size, structure, and also in terms of the who.
Right.
Can
Well, I'll
I
grade it.
mention one more, Catherine, that's just like,
Of
it's a
course,
nitpick,
yeah.
but it's very actionable. We occasionally see, and this is often true in founders' first time raising, it's first round. There's that last slide that says, here's what we want to raise and here's what we're going to do with it, use of proceeds. That's a very helpful slide. And then there's a line that says, and we're doing that for 20% of the company, or here's our expected valuation on the slide. And that is both not done sort of culturally. So it's a weird cultural signifier. And it also shows a lack of awareness of kind of how the market works. You will get to talk about valuation and your expectations in a conversation with an investor if you get that far. But putting it on your slide signals that you're not necessarily ready to have that conversation. So just don't put it in your deck.
That's great advice. We get a lot of questions about that, specifically valuation, and companies saying, should I have a valuation? How do I determine that? I think the consensus is, investors will help you with that, right? When you get into that conversation, they'll do kind of their own modeling too. So best not to throw out a number there in the early stage. So that's a good segue. Oh, go ahead, Brian.
Let me just add on to that. I think it's absolutely true from a valuation standpoint. The other thing that I see that companies try to put out there is what their exit looks like. And if a company is close to exit, then I think that they might have a strong point of view. And if they're engaged in some discussions around with folks, they might have a strong point of view. But a lot of earlier or even kind of mid to early-ish stage companies put out there a point of view around exits, which I don't think has a lot of credibility. It's nice to flash up big numbers and big names and so forth and so on. You see it all the time. And probably the folks you're talking to, whether they're on this panel or not, they've probably gone through a lot more exits and they've probably seen a lot more exits than the company has themselves. And so I just think, kind of to Jenny's point around valuation, that's another area where she kind of triggered my thought that we see that a lot. And at best, we'll say, oh, that's interesting. And we'll come up with our own point of view. And then at worst, did you just look at it and you kind of roll your eyes?
Perfect. No, that's great, Brian. Thanks for adding that. So the last, I know we only have about 6 minutes left, so I want to ask kind of quick questions. The first one being, when you're looking at an investor, a company, does it matter who their prior investors are? How big of a factor is that? Maybe just a quick answer of, if it is a big factor or it isn't. Starting with you, Brian.
I think I might have alluded to before. Yes, I think it is a significant factor. It's a big decision for the company, as I said before. It's somebody that presumably we're probably going to be working with. What's going to be the role? Is the investor going to continue in the round? Are they going to do their pro rata? Are they all of the rest of those types of considerations? Who are they? Are they kind of smart money, if you will? Have we worked with them before? All those types of things, I think, are absolutely considerations. And I think it's one of the reasons, probably not the biggest reason, that you want to make sure you've got credible and strong investors. Frankly, the biggest reason is because I think they can probably help you in terms of crafting the thinking and the connections and the network and so forth. But I think it's another consideration for sure. Yes.
I see Chad and Jenny, you guys are nodding your head on that one. So next question would be, so we talked about, looking at companies and long relationships, but if you've said no to a company, is it a hard no? Should they just, lose your number, or should they come back to you at a different time?
I'll start. And I almost always will tell a company, come back to me. I'm looking for X, Y, Z. When you accomplish these things, come back to me and let me.
It depends. Right? Sometimes we say no because a company is not and will never be a fit with Genoa. We don't invest in therapeutics companies. We mean it. So don't come back with your next round. But in others, we'll be explicit. We'll try to be explicit. We tend not to give a lot of feedback, because if we're saying no, it's usually after one conversation, and who are we to tell you what to do after one conversation? But we will say, not a fit right now. Maybe we don't have the bandwidth, or we're not comfortable with, or we don't think we can get comfortable in time with this aspect of your plan. Do keep in touch as you make progress on that. So we'll try to signal in an authentic way whether we think it's worth your time and ours to continue the conversation in the future. That being said, that doesn't mean send me an update every week.
Right.
So
good. Okay, and then last question on this, kind of a similar, idea. If you place a bet on a particular company, and a direct competitor, or someone who thinks their direct competitor comes to you, would you invest in that company, or would you even advise companies to go to investors where they know they've invested in a direct competitor? So
Yeah,
Jenny, do you want to start? Oh, Chad, go ahead.
I was just going to say, I think it's in the tool space, it's not too often that there's a zero-sum game, right? And so I think most often investments can be complementary, even if they're in very similar spaces. And I think an example is Illumina, and they have not tried, even though they're a reagent player in the space, they've allowed companies or actually promoted companies, and then probably even invested in some library prep companies and sequencing reagent companies. And so I think there's a lot of reason, and those two go hand in hand. And so I think depending on, if you really felt like it was a zero-sum game and one company was going to totally be stealing market share from the other, and I wouldn't be comfortable making that investment. But I think largely, there's a lot of very similar overlaps, and that will ultimately grow the marketplace overall.
Any other thoughts on that question, Jenny or Brian?
Yeah, it's something we take very seriously, of course, because we care very much about the success and wellness of our portfolio companies. But I would say, to Chad's point, it doesn't come up as often as you might think, and so it is worth having the conversation. It's worth having it transparently. You can say, I'm a bit concerned about this company in your portfolio, or are you looking at any other companies? Because generally, as Chad was talking about earlier, we're looking at themes or areas where we want solutions. So we probably are looking at a bunch of companies you don't even know about that are innovating in the space. We're going to take that very seriously. We're going to take confidentiality very seriously. And if we find that if it is a zero-sum game, that where one company's winning would take away from the potential for the other to win, that we would decline in that setting.
Yeah, I came from Thermo Fisher, as I mentioned before. There are very few companies out there that I speak with even today that are not a competitor. With Thermo Fisher, at some level, pretty much everybody, we used to call it co-opetition, because so many companies out there were customers, competitors, collaborators, all of the above, right? So at some level, yes, kind of echoes what Jenny and Chad said. At the same time, if we would not invest in two companies that each have kind of one offering, very focused, and are direct one-on-one. But I don't remember. I maybe think of one example where that really happened, or that even came up, I should say.
Great. Well, thank you all for the the answer on that. I think that's really helpful for our audience. So I know we're at the top of the hour, so I'm going to invite Ayelet back to close us out for our public broadcast.
Thank you, Catherine. And before we turn off the live stream and kind of move on to the private chat with our core companies, I just wanted to really thank our panelists, first of all. This was a really interesting discussion. And thank everyone else that tuned in and joined us. I wanted to invite everyone that found this interesting and relevant to continue joining us every Wednesday at 10 a.m. Pacific time for the next couple of months for our panels. Next week, August 24, we'll be hosting a webinar kind of going back to Jenny's red flag slide The webinar will focus on how to strategically find your beachhead application and market, and focus on that. And this will be featuring Stefan Budell and Carl Scholhammer from DeciBio. So please join us for that as well. Thank you again. Looking forward to seeing everyone again, and have a great day.